Hey everyone, this is Patrick Wheeler here with the Mandrel Company. I just wanted to make a quick video today going over some sample deal analysis and specifically using an Excel spreadsheet that we, or myself, oftentimes use to analyze deals. So getting right into it, basically what we have here is, again, an Excel spreadsheet that does a lot of the work for you. It's very easy, simple to use. Um, and basically what we have here is, again, you'll see a lot of these cells are yellow. And basically what that means is these are the only really cells that you need to worry about inputting your data. Everything else you'll see, for example, numbers here, amortizations, closing, loan balance, cash flow here at the end that we'll take a look at. That's all calculated for you based on the numbers and data that you input yourself. So getting right into it, basically one of the first things that I do when I'm analyzing a deal is I'll look at the purchase price of the property. And purchase price is right here, basically the first cell we're going to take a look at. And I've thrown in an example of $600,000. Today I'm hypothetically using a 3-unit apartment in the Boston area. So we're going to say $600,000, which of course right now is kind of low, but for the sake of this video, we're going to use $600,000. So another thing to keep in mind is, you have your purchase price, but there are closing costs. There are always going to be closing costs in a transaction, usually around 1%. So just keep in mind that your total cost of the loan is actually going to be $606,000. So we'll start back up here at the top. One of the things that you need to know, absolutely is the amount of leverage you're going to use for the loan. Say it's a typical investment property, you're going to need to probably put about 20% down, therefore the 80% leverage. We can play with it in a little bit, but again, if you're going to go FHA or mass housing, or there are other loan programs out there that may give you 3.5 to 5% anywhere there in the area. But for now, we'll use pure investment property, 20% down, so your leverage is going to be 80%. Right after that, we have appreciation. This isn't something that I usually like to factor into my deal analysis too much. I don't invest on appreciation. I don't bet on appreciation. I'm focused on the here and now, and I focus on cash flow. So, typical, standard right now is about 2% per year, especially with the way things are right now. So we can leave that the way it is. Moving down to interest rate. Right now there's a sample, 5%. Again, this is going to vary based on the individual. If you need to know, an exact, idea of what you might be able to get for an interest rate, you can definitely reach out to a mortgage specialist. But for the sake of this, example, we'll use 5%. Again, number of units, we're, assuming a 3-family in the Boston area. So we have the 3 units. And then lastly, market cap rate. It's not something you need to be too concerned with right now. As you further your investing career, market cap rate is sort of a standard, but then it's something that you can kind of develop as a criteria for your investment strategy. It's basically a certain return that you want to hit in your purchases. So a couple things moving over here. Nothing too important, but you have, say total square footage of the property. We're actually working on a property right now that's just about 4,000 square feet, so I use that as an example. And then the value of your land, which you can certainly look up the value of if, MLS definitely has it, or there's other areas as well to figure that out. Moving on to basically the length of your loan. Right here we have term in months. So, a 30-year loan is going to be about, or it is going to be, 360 months. So you definitely want to enter in that. And as far as purchase, those are the biggest things that you want to be paying attention to. A couple other numbers you can see here is the amount borrowed. This is going to be the actual amount of your mortgage or your note. And then right here in monthly payment, you can see what you expect to pay in terms of your principal and interest every month. So again, monthly payment. And as you look over here, there's a couple different numbers here with closing loan balance. You can see from years 1 to 5 what that's going to look like, and again your amortization, total pay down over a period of time. Moving on to the next part of this analysis, which is the income. Again, we're using a 3-unit apartment sample. So what I did to make things easy is for your monthly income, I'm assuming $2,000 per unit. So again, $2,000 for 3 units is $6,000 a month in gross income. On the the column here to the right, you have your annual amounts. So annually, again, a sample, this property is going to bring in $72,000 a year. All right, so that's income. That's typically usually going to be it. I mean, if you have parking or laundry or anything like that, that could add to your income. But for this example, again, we're just going to use, gross rents. So moving on to expenses, this is going to be, arguably the most important part of your analysis. You really want to get this part right and make sure you're including all expenses, and you'll see that in a minute here. And one of the things, especially, your first entry, vacancies. Vacancies, you always want to include vacancies, in my opinion. You are going to have vacancies at some point. It's just a matter of when. So an easy way to factor this in, it's hard, obviously, if you wanted to come up with a numerical value for it per month, but an easy way is just taking a percentage, as you see here, of the gross monthly rents. So 2%, which is a pretty solid number, depending on your area. This is going to be, higher, or typically higher. 2 is, a great number to start. But 2% is usually what I use in terms of, deal analysis in the Boston area. If I was in a more, rural part of the country, I would definitely, be thinking probably, even 8 to 10%, just to be conservative, because I like to be conservative when analyzing deals. So again, as you see here, 2%, your first expense is going to be about $120 a month in vacancies. And again, you can see over the course of a year, it's going to cost you $1,440. So moving on to a couple other expenses, a couple of the ones here, legal, advertising, cleaning, probably not going to be, or hopefully not going to really be expenses that you have to deal with. Cleaning you can include, as part of your repairs and maintenance, but as you'll see down here, there's already a row for repairs and maintenance, so I wouldn't really worry about cleaning. If you have someone that takes care of your properties, cleaning, you can include that, of course. But moving down the list, we have miscellaneous. This could be, anything that comes up that, isn't in your typical analysis. But for now, we're going to leave that blank. Excuse me. And the next one is insurance. Insurance, of course, you have to have insurance on your properties. And for this example, I used an annual, it starts to get to annual amounts for the expenses of $2,000 a month. Again, this is going to vary depending on the type of policy that you take out for your property. But typically, again, using an example that on a 3-family that we're working on right now, we have a policy for right about $2,000 a month. So again, you can see what that breaks down to monthly, which can be a little easier to look at when you're kind of analyzing a deal. So moving on to property management. Again, property management, in my opinion, is something that you should always be factoring in, whether at the time of purchase that you plan to self-manage, or even if you're going to be living there, or really in any scenario. I think you should be calculating property management, because you have to assume that someday you're not going to want to take care of the building, whether you move out or your portfolio starts to grow. There's going to get to a point where it's just too much for you to handle. So if you don't analyze that from the beginning, you might today make a purchase that actually doesn't make sense. Say 5 years from now, when you decide to hand it off to property management, and now they're taking, in this example, $470 a month out of your income. So if you ultimately analyze the deal and you're cash flowing $400 and you say, hey, that's great, but then a year down the line you hand it off to property management, and then there goes $400 of your monthly profit. So again, you can see an annual amount, just over $5,500 a year it's going to cost you. So it's definitely a hefty expense, and that's especially why you want to make sure that you are paying attention to it and including it. So next expense, property taxes. This one is, usually pretty easy to find out. If you're using MLS, the property tax is always included. If you don't have access to the MLS, there's different town or city websites that you can use to find out the taxes for a property. For this example, I put about $5,500, which for a three-family, again, that's another number. The tax rate of properties is going to vary by areas, but in the Boston area, for a three-family building, right around $600,000 purchase, that's going to be pretty close to what to expect for property taxes. Again, moving down, here we have a couple of expenses grouped together. We have water, sewer, electricity, and garbage. Right here is a little important to point out. Water and sewer are usually going to be grouped together. I usually, for a three-family, run about $100 per unit. And then again, the same thing for electricity. And garbage, obviously in the Boston area, you can just put the garbage out in the street. And again, it's important to know if you're looking for, or if you're analyzing a deal, determine what expenses you as the landlord are going to be responsible for. So it's important to find out, again, heat, water, electric. You want to know which of those you might be responsible for, or the tenants are currently paying. So for this example, basically I just kind of reverse engineered a couple of these. I said that that's going to probably cost you about $400 a month. So that way, obviously, when you just times that by 12 months of the year, you get $4,800 of an annual cost for your water, sewer, electric. Next expense, repairs and maintenance. This is another one that you kind of want to use a percentage, in my opinion. I usually try to use about 5% of the gross monthly rent again. And if you do that calculation, 5% of $6,000, it's going to give you, the $300 a month, and again, equivalent to $3,600 a year. Again, repairs and maintenance, something that I always factor in. There's going to be issues that come up every year, most likely. So, the sooner that you calculate them, the sooner you can plan for, your cash flow to be hit a little bit, and, make sure that it's still a good deal. So that's really it for the expenses. Again, a couple things I just want to point out again to make sure that people really factor these in. Vacancies, property management, and then repairs and maintenance. Those are percentages, including repairs and maintenance. Those are percentages that I, would really stress you paying attention to and factoring into your deal analysis, because again, these things are going to come up at some point, usually no matter what. So it's best to do, the analysis ahead of time. And again, making sure, because the point is to find a good deal. So then, moving down, we have total operating expense. Get the expenses for, all your monthly and annual costs, your gross operating income. Again, this is obviously just going to be, the income minus the expenses. And then, that's just going to be, your total income for the year, and then net operating income is going to be your income minus expenses. So as you can see here, the net operating income for this property is going to be, just over $49,000 over the year. Your mortgage is the next thing. So your mortgage, again, your monthly payment, as we found right here, it brings it back down here to about $2,500 a month, which is going to be $30,000 a year. So your cash flow, what you can expect to receive in cash flow, and this is the main number that I'm most concerned with when analyzing deals. So your cash flow for this sample, you have just over $1,500 in cash flow every single month, which is a pretty good number, for a typical three-family in Boston. Basically, after that, you can look at, again, here's your annual cash flow, which is the same number here, and then if you want to get into your taxes, and then after tax cash flow, you can see that here as well. A little further down, if you want to get really in depth with this spreadsheet, you kind of have like an outlook of year to year what your income, your expenses, and your kind of your returns are going to look like over the course of in this example 5 years. So one of the last things to point out, arguably, most important for some people is your cash-on-cash return in your first year. So in this example, we have 14%, which is actually really good. Based on this example, again, this is a hypothetical example. But again, so what you see is 14% cash-on-cash return. Basically, that's the amount of money that you put into this investment, and that's divided by your annual. So as you see, once you get your net operating income, one of the last things to take into consideration is, again, your mortgage payment, your monthly mortgage payment, which again is found about here above. So one of the last things that you want to take into consideration is the mortgage. And again, the mortgage is just over $2,500, which we did see earlier, above when you start talking about some of the purchases and the purchase entries. So again, back down here, factoring in the mortgage, and then at the end of the day, when all is said and done, your cash flow, which is right here, is just over $1,500 a month. Again, for this sample analysis, a 3-unit apartment is actually, that's a pretty good monthly cash flow. So if you look down a little further, again, your annual cash flow is right next to it, which is the same number right here. If you want to get into the taxes, what it's going to cost you, you get into your after-tax cash flow, which is right here. So basically your walk-away money at the end of the year. One of the last things that you can take a look at when you're analyzing a deal is your cash-on-cash return, and you can see that here. So in this, again, sample example, we have a 14% cash-on-cash return, which is pretty good. That's something that I would be happy with as a return. Again, this number is going to be, is going to vary per individual. Some people want to are comfortable hitting, maybe an 8% return. Others, want to hit double digits and won't look at anything else. So again, taking a look at everything, your purchase entries, taking a look at your income, expenses, make sure you factor in everything. The spreadsheet will calculate all the rest for you. You get your cash flow, and hopefully, again, one of the biggest things probably you want to look at the end of the day is your cash-on-cash return. So that kind of wraps up the sample deal analysis. Again, this is the spreadsheet that we use primarily in the office. If you did find this helpful and you would like to have some access or have this shared with you, just click on the link in the description to download this now. And again, you'll have access to all the things that in this spreadsheet that we have access to. All right, so hopefully you found this video helpful, and we'll talk to you next time. Thank you.
Thanks for watching our video. Did you find this information useful? If so, please remember to like the video and also subscribe to our channel for more useful information. I would also encourage you to share this video with your friends and family. Thanks again, and we'll talk to you soon.